Hello and welcome to our latest Insider interview. Today in the studio I have with me James Cook, Co-Fund Manager of the JPMorgan Global Growth Income Investment Trust. James, thanks for your time today.
Oh, thank you very much for having me.
So James, over the past 5 years, the investment trust has outperformed the average global trust. You've also beaten your benchmark, which is the MSCI All Country World Index. So what have been the key performance drivers over that 5-year period?
Yeah, it's a good question. We're quite glad to say there's no individual theme, there's no individual stock that has delivered this for us, and that really comes back to the consistency and the quality of the alpha, that we're getting it from many different sources. So if you look at the past 5 years, as you said, we have delivered positive excess returns in over 70% of the sectors that we've invested in. We've delivered positive excess returns in all of the regions that we've invested in. And hopefully that gives clients a feel for the consistency, the reliability of the alpha that we've generated. And personally, I think that's what separates us from some of the other strategies out there that may have delivered the magnitude of the alpha. But it's really the quality of the alpha that we've delivered. So as I say, it's come from a broad number of stocks. But if you take, for example, the past year, an area of real success for the strategy has been in the high growth cohort. So one of the things that we have done is we've been overweight to the semiconductor cycle. That's played out really well for the strategy. It's been the best performing part of the market over the past year, or over 2023. So that was definitely a big positive. But also within media, we've had some real success there. So focusing in on the companies that we've that I've mentioned in the past, the names that have been successful at picking up on AI. So your Microsofts, your Metas, your Nvidias of the world as well. But also avoiding the unprofitable growth parts of the market and investing in media stocks or e-commerce platforms that have improved their capital discipline has also been a real area of success for us.
It's a global approach. I noticed there's a very little amount of exposure to the UK. Why is that the case?
When you think about the barrier to make this portfolio, the hurdle rate is incredibly high. We look at 2,500 companies worldwide. It's the top 50 ideas. So to get above that hurdle rate is first of all, the incredibly difficult to do. The second part, though, is we do actually find some interesting opportunities within the United Kingdom. We have names like Shell, where we think the free cash flow yield of this company is incredibly attractive, a 15% free cash flow yield. And we're seeing corporate governance improve, and hopefully we expect to see the valuation discount relative to its US peers begin to narrow. But second to that is we also have names like Relics, where a really good software company in our eyes. We see it as a software business, and again, their ability to monetize AI with later generations of the software, we think that's going to be a new revenue growth driver for the company going forward.
You've explained that you set a very high bar for companies to win a place in the portfolio. How often do you make changes to the portfolio, and could you run through some of the most recent changes you've been making?
Our turnover is around 70%, which may feel a little high for a fundamental long-only strategy. But the reality is about 2/3 of that is used on adding and trimming stocks dependent on where the valuation of our companies currently lie. So the real holding period for our names is around 3.5 years, which is much more sort of typical of a fundamental long-only strategy. That's the first point I would make. The second point, though, is to your question is what have we traded more recently? And over the past quarter, for example, we've kept the shape of the portfolio the same. We're still exposed to the high growth parts of the market, in particular the semiconductor cycle. We're still overweight to the defensive part of the market, and our main underweight is to the low growth cyclical part, where we think earnings are currently well above normal levels. We think they are at risk of coming down. So first point is that we're keeping the shape of the portfolio the same. Within that, though, as you've as we've talked about, the performance has been really strong. So we have tried to rebuild valuation back into the portfolio. Some of the stocks that we've had have outperformed quite significantly. So we've trimmed many of our winners and redeployed into some of the underperformers within the portfolio that we think have that we still have conviction in. So, for example, we've sold out of Conoco, a US energy stock, and we've redeployed that back into Exxon, where we saw 1.5% free cash flow yield pickup. It's got $10 billion of net cash. It's got cost out reduction programs. They've got high grading of their energy base. So we see some, we think the valuations there look attractive. Also within the cyclical arena, we've trimmed our positions in Safran, which is a French-listed aircraft engine manufacturer. The stock's done pretty well over the last quarter, even last year as well. So we've trimmed part of that position and put it into another holding, Deere, which is a US-listed tractor company. And we see really attractive long-term growth potential from precision ag. And also the stock has underperformed on the back of a pretty tough crop cycle.
In the previous video, you explained how you've got some exposure to the artificial intelligence theme. What other themes are you playing in the portfolio for the long term?
Yeah, good question. So if you look at our top 10 holdings, we've got MasterCard. So as you go from a cash society to a cashless society, we still think there's decent runway for growth there. Particularly within the emerging markets, but also if you look at the US market, 30% of transactions in the US market are still done either via cash or checks. I mean, as archaic as a check is, it's still prevalent in the United States. So we still see runway for growth there. Also within cross-border activity, we still think that's relatively low versus trend. So we still see a pickup potential, which is quite meaningful for MasterCard. We've also got, I discussed a minute ago, we've got Deere. And the long-term opportunity for Deere is in precision ag. So they have a leading franchise in spotting the difference between a weed and a crop with their technology. What that means going forward is that you need less pesticide to put on the fields for farmers, which is not only good as an ESG winner, but it also means cost efficiency advantages for the underlying farmer. And we think that they will take market share with that newer product that's going to come down the road. And then finally, maybe with Chicago Mercantile Exchange. This is again a US listed exchange which has plenty of products in derivatives, commodities, and interest rates. And again, we think that the macro volatility going forward will still be heightened. There's still lots of hangovers from COVID period. And we think that volatility over 2024 will likely increase, which means more transaction volumes for Chicago Metal Exchange, which for an asset-light business model is trading on attractive valuations.
And how does the wider macroeconomic backdrop influence your investment decisions? For example, at the moment, a lot of commentators think the interest rate cycle has potentially peaked, and we may see some interest rate cuts in the US and potentially here in the UK in 2024. So if interest rates are cut, would that impact your investment decisions? Would you think about sectors or companies that might benefit more than others in that scenario?
Absolutely. If we knew that with certainty, we'd probably lean into high growth a little bit more. But the reality is, we don't think we're macro experts. We're stock pickers at the end of the day. That's our bread and butter. We've made substantial alpha by sticking to that, and that is what drives the portfolio going forward. So from that perspective, we try to limit macro bets within the portfolio and really try and keep it to stock picking and just finding those best 50 ideas across that universe.
Investment trusts have the ability to gear, borrow to invest. At the moment, the investment trust that you manage doesn't have any gearing at all. Is that typical, or does that show that you're being more cautious than usual?
We have the ability to go from anywhere from 5% cash levels to 20% geared. At the moment, we are currently zero gearing. And to your point, yes, we are a little cautious on the market. When we break the market down into its components, we think valuations are a little above historical averages, but nothing egregious by any metric. However, when we look at the earnings profile of the market, we do think that the market has been over-earning post-COVID. So if you look pre-COVID, margins of the global equity market ranged anywhere from 11% up or down by 1% either side of that from 2011 to 2019. An incredibly consistent margin profile. Post-COVID, we obviously had this demand stimulus. We had supply constraints across the world, and any textbook macro expert will tell you your profit margins are going to skyrocket, and that is exactly what unfolded. Profit margins jumped to around 15%. Since then, supply has sorted itself out to some extent, and profit margins have come down by over 1% since then. Now, the market believes that we're going to go back to record profit margins and, if anything, actually exceed them. We just think that's unrealistic. We think demand has not normalized yet. And when we see demand begin to normalize, we think more likely than not, we're going to get further margin pressure. And it's more likely that we go to a pre-COVID level margin. I think there are elements that the market has improved at, particularly possibly with AI. But it's more likely we go to pre-COVID level margins than we do stay at elevated or new extremes. So from that perspective, we think earnings are at risk. And in particular, it's towards the low growth cyclical part of the market, which is where our largest underweight is. So think about your industrial cyclicals, your consumer cyclical stocks. And then finally, as I'm painting a bit of a negative picture at the moment, the reason why we're not sort of sitting in net cash is because we still think there is a significant amount of opportunity to find high quality businesses that are underpriced. So the ability for us to generate excess returns above the market is what keeps us towards a 0% gearing or 0% cash position.
And finally, the question we ask all fund managers we interview, do you have skin in the game?
Absolutely. So part of the JPMorgan incentive package is 50% of that will be given to a fund manager. It's allocated by your manager to go into the strategies that you manage. So for me, that's JGGI. And then you get another 50%, which you get to select. Now for me, again, over the last 2 years, I have allocated that full 50% back into JGGI as well. So I'm 100% invested into the strategy.
That's good to hear. And James, thanks for your time today.
Thank you very much.
So that's it for our latest Insider interview. Hope you've enjoyed it. Let us know what you think. You can comment, like and subscribe. And hopefully I'll see you again next time.